What happened on Thursday wasn't normal. Gold dropped nearly 4%. Silver collapsed more than 10% in a single session, and if you were just watching the chart, it looked like panic. But underneath that red candle, something far more important broke. And almost nobody is connecting the dots yet, because while the paper price crashed, physical buyers stepped in aggressively. Eastern markets paid a premium. COMEX inventories drained. And the divergence between paper and physical widened, not narrowed. That's not random volatility, that's structural stress. And today we're breaking down exactly what happened, why it happened, and what the data is telling us about what comes next for both gold and silver. Because this isn't just about a price drop, it might be about a shift in who controls price discovery. Hey, James here. This is Noble Metals. And before we go any further, if you value independent analysis, real data, and macro context without mainstream spin, subscribe, because in markets like this, information asymmetry is everything. Now, let me ask you something. Where are you watching from? Drop your location in the comments. This community spans continents, and time zones matter when global markets start to fracture. All right, let's get into the data. Current pricing at time of recording. Gold spot $4,956, down 3.97%. Silver spot $76.74, down 10.65%. That's not mild volatility. That's forced liquidation behavior. Now, here's what most people think when they see this. Precious metals are crashing, but serious investors ask a different question. Who sold? And who bought? Because markets are not emotional, participants are. And when price drops violently in a short window, it usually means leverage is being flushed, not value being destroyed. Let's start with gold. Gold dropping nearly 4% in one session at these price levels is significant, but context matters. Gold recently broke above the psychological $5,000 level. Psychological levels attract breakout buyers and short sellers defending the level. When gold approached $5,000, it triggered profit-taking, stop-loss cascades, algorithmic shorting, and options hedging, which creates a fast drop. But the key question is, did physical demand collapse? No. Central banks are still accumulating. Eastern premiums remain elevated, and gold ETFs in Asia continue seeing inflows, which means the drop was paper-driven, not demand-driven. That distinction matters because gold is not just a commodity, it is a monetary asset, and monetary assets don't collapse when debt cycles turn, they respond. Now, let's talk silver. Silver is not gold. It's more volatile, thinner, more leveraged, and trades like a hybrid between a monetary metal and an industrial commodity. A 10% single-day drop in silver feels catastrophic. But historically, silver does this before explosive upside moves. It shakes out weak hands, triggers margin calls, creates emotional capitulation, and that's usually when long-term accumulation quietly increases. But here's where silver gets interesting. While the Western paper price collapsed, the Shanghai benchmark fixed nearly $10 higher. Eastern physical buyers are paying a $10 premium over Western paper prices, and that's not noise. That's a signal. If there's a $10 spread between two major global markets, arbitrage traders normally close it by buying cheap in the West, shipping it east, selling at a premium, and pocketing the difference. But that spread has persisted, which suggests capital controls, logistical constraints, or insufficient physical metal to close the gap. When arbitrage fails to function, markets are fractured, and that divergence is structural. Moving to COMEX, over 3.2 million ounces were removed from registered silver in a single day. Total registered silver fell below 100 million ounces, and nearly 4.7 million ounces left the vault system in 24 hours. Paper price falls 10%, but physical inventory leaves the vault, which suggests withdrawal, not liquidation. When registered inventory declines while price drops, it indicates physical buyers are absorbing supply quietly. And eventually, paper price must adjust to physical scarcity or settlement mechanisms change. Trading paper gold or silver means trading a derivative, a claim, not necessarily the metal itself. When registered inventory declines and open interest remains high, leverage rests on a shrinking base, and confidence-based systems remain stable until they are not. Zooming out, 18 U.S. companies with liabilities exceeding $50 million filed for bankruptcy in 3 weeks. Household debt reached $18.8 trillion. Credit card delinquencies climbed to 12.7%. And late cycle stress historically leads to rate cuts, liquidity injections, and currency debasement, which benefits gold first and silver second. Gold serves as central bank accumulation, monetary hedge, lower volatility, first responder, while silver offers industrial demand, monetary leverage, smaller market size, and explosive late-cycle performance. Historically, gold moves first, and silver moves harder later. The bearish case includes technical damage, potential cash settlement, recession, reducing industrial demand, and consolidation below $5,000, but the structural debt burden does not disappear. Debt gets inflated away, currency loses purchasing power, and hard assets preserve it. Monetary easing weakens currency, which strengthens gold and eventually silver. Bitcoin has not yet proven itself in sustained tightening cycles. While gold and silver have survived multiple resets, India added approximately 40 million ounces of silver into ETFs within 2 months, and Shanghai Futures Exchange, enforcing stricter hedging quotas, signals structural grounding in physical activity. David Morgan suggested most bull market gains occur in the final phase, and volatility may represent compression, not failure. Watch signals include Shanghai Premium, COMEX inventory, bankruptcy pace, delinquency rates, Federal Reserve tone, gold near $5,000, and silver structural support. If confidence shifts and delivery demands rise, adjustments occur through margin changes and settlement mechanisms reflecting stress management. Gold reprices suddenly when debt cycles mature, and silver amplifies once gold establishes strength. In crisis phase 1, liquidity pulls everything down. In phase 2, central banks intervene and real assets surge. Capital rotates from equities to commodities to precious metals, and timing matters more than chasing spikes. Even in stabilization scenarios, the structural debt overhang remains, and hard asset thesis persists. Gold stabilizes, silver accelerates, and markets test conviction during compression phases. Bull thesis weakens if premiums collapse, inventories rebuild, real rates rise sharply, dollar strengthens, or inflation falls below target sustainably. The big money is made in the big swing, driven by structural shifts, not daily noise. This is educational analysis, not financial advice. Debt compounds, currencies debase, hard assets reprice, and the question is positioning rationally, not emotionally. Protect capital first, opportunity second. Verify everything. Trust nothing blindly. Invest with logic, not hype. That's the full framework. Where are you watching from? Are you buying this dip or waiting for lower prices? Subscribe for deeper breakdowns, because what's building in gold and silver right now is bigger than a red candle. Gold serves as the first responder to monetary stress, and its stability gives silver the runway to accelerate. Markets test conviction during these compression phases, and the role of central banks becomes critical in stabilizing liquidity and controlling the cascade of forced liquidations. When we see inventory drawdowns and persistent premiums in Eastern markets, it reflects structural shifts, not temporary trading anomalies. These patterns suggest that those who understand physical demand versus paper derivatives can anticipate the next phases of precious metals cycles more effectively. Silver, due to its smaller market size and hybrid nature, reacts faster and more dramatically. Margin calls, emotional capitulation, and liquidation events in the West often precede accumulation by institutional and Eastern buyers, creating divergence between paper pricing and physical scarcity. COMEX withdrawals, Shanghai premiums, and ETF inflows all signal that the market's underlying health and demand are stronger than short-term price action implies. Arbitrage inefficiencies signal structural stress and constraints on liquidity, not a failure of value. Investors need to separate emotional reactions from rational analysis. Price drops alone do not indicate a market collapse. They often represent leverage being flushed and weak hands exiting. The focus should be on who is accumulating, where physical demand is concentrated, and how structural stress in delivery systems influences future pricing. Historical patterns show that gold stabilizes first, silver follows, and this sequence offers strategic insight for long-term positioning. Monitoring COMEX inventories, Eastern premiums, and policy signals is essential for understanding market mechanics. Paragraph 14. In addition to the financial metrics, macroeconomic stress signals such as bankruptcy rates, household debt, and delinquency levels provide context for precious metals performance. Monetary policy, liquidity injections, and currency debasement have historically benefited gold, first and silver second. Investors must observe both technical indicators and structural fundamentals, as these combined forces dictate market behavior during late cycle conditions. The interplay of debt, currency, and asset scarcity drives realignment in global precious metals markets. Finally, positioning matters more than speculation. Protecting capital first, identifying opportunity second, and understanding the divergence between paper and physical demand will define outcomes. Markets are fracturing along structural lines, and timing the swings rather than chasing spikes ensures rational investment decisions. This is Noble Metals, and if you follow these principles, you will understand that what's building in gold and silver right now is far bigger than a red candle. The full framework has been laid out, and awareness of these dynamics is essential for anyone navigating the current precious metals landscape.